All right. Good afternoon on this Hump Day Wednesday. I've got Dennis Sheffield and Michelle Grant here from Big Life Financial Services. We're going to talk a lot about how to build wealth through permanent insurance. And so, those that know me, I'm always talking probably for the last 20, 30 years on building wealth through real estate investing. But we know that we can build wealth through permanent insurance, and so that's what we're here to talk about. Um, let's start with you, Dennis. Why don't you just introduce yourself and just basically give us your background as it relates to the financial services industry.
Great, thank you. Thank you for having me, Greg. Again, my name is Dennis Sheffield. I'm a financial strategist. I have been in the industry on and off for over about 25 years, but as of late, the last 15 years or so, my specialty in the industry is pretty much helping pre-retirees in terms of position themselves for putting themselves in a better position for their retirement as it pertains to creating annuities and IULs, which is a form of life insurance. Uh, my business is Sheffield Financial Services. I'm here in the DMV area and always available for questions for people who may have some interest.
And if you guys have questions, go ahead and put them in the comment section. This is interactive. We want you guys to understand the power of insurance. So if you have any questions, just put them in the comment section. Michelle Grant, what has your financial services journey been like?
Um, well, I've been all over. I've been a real estate agent since um, in the 90s. Okay. And then I also got into insurance when the real estate field kind of plummeted back in 2008. And in that realm, I've learned a lot about insurance, and what I've learned is how IULs, permanent life insurance, can definitely be a great source in building wealth and also protecting your assets.
And so when we talk about insurance, it's basically two types of insurance. It's temporary insurance, there's term insurance, and then permanent insurance, which is universal life and whole life. Um, Dennis, why is permanent life insurance so important as it relates to building wealth?
Because it's dependable and it's consistent, meaning that, of course, depending on the type of permanent life insurance you choose, you can have a consistent premium payment, so that doesn't fluctuate, that doesn't change, and then you also can have a consistent death benefit. So when you're talking about putting a financial strategy, a financial plan together, when you have a permanent life insurance as opposed to a term, then you can actually include that in part of your overall planning. Whether it's when you make your transition, you know that your family, your assets will have X amount of dollars left to them based on what's in your life insurance policy, not to mention anything else you may have in place. So it's a highly needed tool when it comes to putting a financial strategy together.
Michelle, you want to add to that?
Yeah, and with nowadays with the different types of products that we have in permanent life insurance, we have whole life, we have ULs, IULs. In particularly with the IULs, you have what you call living benefits with these products, and you also can build what we call a tax-free retirement, so that when you retire, you can have enough cash build up to have a tax-free retirement. And as we know, taxes go up. They don't usually go down.
And yeah, and so permanent life insurance is one of the best ways to build um, a tax-free retirement. Also, what I like about permanent insurance, I was sold a term policy probably I'll say 30 years ago, but let's just say 25 years ago. I was sold a term policy. It was a 20-year term of which I outlived. And so the
Mhm.
term policy went away. But during that 20 years, I had kidney failure and have recovered from that. But now since I outlived the policy, it's very, very difficult for me to get permanent insurance, even another term policy. But had I gotten permanent insurance at that time, that insurance would have continued. I would have had no problems whatsoever. And so, and I was sold on the fact that, hey, get term policy, which is cheap, and then invest the difference. Now, I did invest. I invested in real estate, but I didn't invest in the stock market or annuities or anything like that. And so I think that that's what we're taught. And I'm a prime example of, we're taught on getting the cheapest insurance and then invest the difference. But in most cases, we don't invest. Have you guys experienced anything like that, or just kind of have any opinions on that?
Yes, absolutely. I would like to add to that. I think the biggest issue is that in our community, we are very transactional oriented, meaning that we're just looking at what can I get for X amount of dollars, as opposed to putting a financial plan together. And so when you do that, then term insurance does have a place. Again, it's great for if you want to use it for what they call mortgage protection. Average person, you purchase a home, it's for 30 years. So a term policy would be great in that scenario. And then there's other scenarios. But again, as you just mentioned, if it doesn't have what you call the convertibility rider, which means you can take it from a term to a whole life, then once it expires, it's done, it's gone. And in your situation, if you have experienced some health issues during that time, then yeah, it's going to be harder to qualify for another term policy or whole life policy. So when you're sitting down with an advisor or an insurance agent, you really want to put a plan together that says, here's where I am now at whatever age. And when I get, most people, it's retirement age 65, where am I going to be? What would I have in position to live a comfortable life? And when you take that approach, you're not just looking for a transaction. What can I get for X amount of dollars? You're putting a plan together. So that's one of the things, as being a financial strategist, that's one of the things I like to share with clients, is that we got to look at the long term. It's not just the immediate need, but what's we're going to have, 10, 15, 20 years down the road.
And then also with permanent insurance, there's cash value. And so you're building up cash. And so explain how that works, Michelle.
Well, with a permanent policy that builds cash value, and once you put that money in there, and I'm just say IUL, for example, it right now what's the advantage to an IUL is this: you can take advantage of when the market goes up, but when the market goes down, you don't lose anything. Okay, and so with IUL, it allows you to be able to build money. It allows you to, with most of them, to protect your family in those cases where if something happens to you, if you should happen to have something chronically happen to you, because a lot of us have strokes, aneurysms, things like that, like myself. We survive through those things, but if we don't have something in place, that's where our families kind of lose, because the breadwinner now can no longer work. And so we don't have anything in place for that. And that's what I love so much about IUL, because you can have that, but then you also have the death benefit if you should pass, but you also have the retirement piece of it, and it's tax free. And when it comes to having tax free as you get older, that becomes very important. And what I love about insurance is that it's automatic. You put it in there, you have that working for you, and if you start in a young age, you can be able to have that later in life, on several different avenues of your life.
And IUL, Index Universal Life Policies. And so, Dennis, with the cash value that Michelle just explained, are you able to borrow money against that cash value? Are you able to take loans out from yourself?
And that is the beautiful thing about a cash value life insurance, is that it gives you that option. And in some instances, it's like you becoming your own bank, so to speak, as opposed to going elsewhere. You can go to yourself and borrow from yourself. And of course, you want to pay yourself back. And then it's even better if you pay yourself back with interest, as you would if you were to borrow money from a bank or a credit union. So that is the beautiful thing about it, is that, as Michelle mentioned, it is tax-free money. So again, you put money into the insurance policy. A portion of that goes into a cash value, depending on what type of policy it is. And then if the needs arise, you can borrow that money from your cash policy, and you had an option to either pay it back or not pay it back. And of course, if you do, it's better for you. But if you don't, then it's just a win-win situation. So yes, you can borrow from the cash value in your policy, and depending on what type of policy you have, it may or may not affect what we call the death benefit in that policy. So yeah, it's a win-win situation, and you can borrow from the cash buildup.
You can borrow money, you can charge yourself whatever interest you want, or you can charge yourself no interest. It's your money. You're your own bank. Mm-hmm. And so when we talk about building wealth, using that cash value is a great option, as opposed to having a term policy, which is temporary insurance. There's no cash value accumulation. With these permanent policies, Michelle, mm-hmm. Are you able to get a long-term care rider?
Yes, many policies you can get that. Yes, you can.
And yes, what's the benefit of that, of getting the long-term care rider?
Because life is unpredictable. That's the good thing. Okay. And you never know at what point in your life that you will need that long-term care rider. And, I see in many instances, people who don't have it end up losing a lot of things that they acquired because the event did happen in their life. I work with Medicare patients, and some people end up losing their homes because they don't have that rider along with it. So, and we call it, some of it call it living benefits. There's different names for it with different carriers. So, but you can get something that does have something in there, a long-term care rider in it. Yes.
And I highly recommend that. I don't know if you know this, Michelle, but I've been researching assisted living facilities of recent. Mm-hmm. And as a real estate investor, that's the direction that I want to now go into for a lot of reasons. But then the question is, for me anyway, so you build or you renovate houses to be assisted living. How are your clients, how are they paying for that assisted living facility, which for each room is like $4,000, $5,000, $6,000 a month? How are they paying for it? And the answer is, part of the answer is long-term disability, mm-hmm. long-term care. And what we're seeing now is the baby boomers are coming up. There's more baby boomers. That's the largest generation we have now. Their biggest issue is long-term care. Where are they going? Mm-hmm. And so I have a situation in my own family where I've got aunts and uncles now in their 90s and 80s, and they've been staying with other family members, but it's getting to be too much. Mm-hmm. It's just getting to be too much on the other family members. And so now you've got the old taking care of the older. And so and that's exactly what it is, at least in my family. You got 70 and 75-year-olds taking care of 80 and 90-year-olds. Mm-hmm. They just don't have the strength to do it. Mm-hmm. Assisted living facilities is one of the options. It's a great option. But how are you going to pay for it? Now, Medicaid pays a portion, but then long-term disability. And so I would highly recommend, as a long-term strategy, to get the long-term disability. And then with these policies, you can get that as a rider. It's very, very inexpensive. And the younger you are, the better, because it increases every year. I think at 5% or something like that. Mm-hmm. It increases every year. The money that you have that's growing, Dennis, you have any idea at what percent is it growing inside of your policy, that cash value?
And again, so it depends on which type of cash value policy you have. If it's just traditional whole life, on an average, it's about 3, maybe 4%, just your traditional whole life cash value. But as you go with the IUL or IL, I should say UL, it can vary. It can go anywhere from 6, 7, 8%. The beautiful thing about the IUL is that it allows uh, the cash and the cash value to benefit from what's going on in the economy. As Michelle alluded to earlier, it's index. So we know the different index, whether it's NASDAQ or Dow Jones, it identifies with the index. And over the last 15, 20 years, we know that the economy has been doing extremely well. So you can look at cash values as of late, and you can see them as high as 8, 9%, just because the economy has been doing just that well. So if it's an IUL and the cash value is index, then it can be, it can be as double digits, but on an average, you're probably in an index 7, 8% in terms of your cash value. And now when you think about that doesn't have it's not taxable, then it's considered even higher, right? Because most of our returns is taxed. So therefore, if you're getting a 12% return and then you tax at whatever 28% tax bracket, as an example, it's not actually 12% that you're receiving, right? But in the index IUL, let's just say if you're getting 8% and you're not paying any income tax on that, then that can be the equivalent of receiving as much as a 12, 14% return, if you want to use the terminology return on your investment. In insurance, you're not investing in insurance, but just the equivalent to make sense of it all. So yeah, IUL just makes sense overall. It just makes sense.
And it's all growing tax free.
Correct.
Now, and so it kind of leads me to think about so we're in an area of the DMV where we've got a lot of federal government workers, and so most of them have a life insurance policy called FEGLI, Federal Employee Government Life Insurance, which is a term policy, but it's a group term policy where the premiums go up and the coverage goes down every few years. What's the difference? What's the difference, Michelle, in a whole life policy or a universal life policies in terms of the premiums?
Oh, the premiums are level. So and also the death benefit remains the same. It doesn't decrease the death benefit. So everything is level, the premiums and the death benefit.
And then what about the cash value, Dennis? Is there cash value in that term policy as opposed to like permanent?
Well, in a traditional term policy, there isn't any cash value. Some term policies now are having a feature that they call return of premium, meaning that if you don't exercise it within that specific time, they will return your premium. But that's not the equivalent of a cash value, if you will. Again, most term policies, just that is, I like to say, it's the equivalent of car insurance. If you have a car insurance, if you have an accident, you use it. If you don't have an accident, you don't. That's what term policy is. Now, traditional term does not include cash value, but the federal term, I'm not 100% sure if that does or does not.
No, it doesn't.
Okay.
Nope.
Is cash value protected by market loss? That cash value, let's say you have a UL, is it protected by market loss?
Yes. If the market does a dive, then some of them will give you a guarantee of 1, but most of them will have a 0 premium, 0%. You just remain level.
You
want to add to that, Dennis?
Right. And in addition to that, you don't lose what you have already gained. So if most people think of traditional stock market, well, it goes up, then it can goes down. The thing is, when you have an index life insurance, what that is doing is that it's giving you a floor. It was actually giving you a floor and a ceiling, and the floor is at 0, so you will never lose what you have already accumulated. But you can make more than you would in traditional cash life. So again, that makes it a win-win situation. So let's say 1 year you make a 7% return, and the next year you don't make anything, then you still have that gain that you got from the previous year. So it's always growing. It's never losing its value.
It's always, so it's always growing. So it's guaranteed growth every year.
Exactly.
And so when I say to you, it's guaranteed growth every year and it's growing compounded, so you're getting compounded interest. What does that mean? For someone that doesn't know what compounded interest means, what does that mean?
I like to say that's like if you want to use an analogy, it's like back in the old days when the farmers used to want to have children so the children can come and help them work the farm. That's what compound interest is that the money that you're earning is working for you as well. So oftentimes, people think that, okay, I made X amount of dollars on whatever type of investment. The compound that is that once you put that money back into the original principal, if you will, now you got more working for you, if that makes sense. So again, use analogies that, back in the day when people when people was farmers, they wanted more children to help them work the farm. That's what compound interest, if you can use that as an analogy, is that the money that you're making on your original principal is working for you to help you make more money.
And so, question for both of you guys. We talk a lot about index universal life policies, which is a great retirement strategy. For those that will look at this podcast, explain exactly what index universal life policy is and what are the benefits of it. You start first, Dennis.
So index universal life policy is basically an insurance policy that has a cash value attached to it. And it's the cash value is attached because it's separated from, if you will, the death benefit. And that gives you the benefit of that cash value to take advantage of what's going on in the marketplace. It's hence the words being indexed. And by doing that, you're getting a greater growth, as well as it's not being taxed. It's tax-free. We don't like to say income, but it's a tax-free value that you are accumulating. So that's the main one of the main advantages of index annuity is that it's two separate. The insurance is separate from the cash value, and that's being indexed into the market.
You want to add anything to that?
Yeah. And with today's index universal life basically is a life insurance policy, like you said, that is tied into the market. And the difference between the IUL and the whole life is that when you build cash into an IUL, if you borrowed against it, let's say you have a death benefit of $200,000 and you built $50,000 in it. Your beneficiaries, if you upon your death, would get 200,000 plus the cash value. Where a whole life policy, you could have built up $50,000 in it and have a $200,000 death benefit. When you die, you just get that $200,000. You don't get any of the cash that was accumulated also in that policy. So that's the difference between a whole life and an IUL. In addition, like I said, a lot of IULs has some of the critical care, chronic illness to it, and just like you said, when you pull the money out, you can take it out tax free.
What age? What's the best age to start? Is this something that when a 30 or 40-year-old starts thinking about retirement, they should get the IUL?
Well, I'm gonna tell you, my analogy is, because I'm a grandparent, is that get it for your kids, the grandkids, when they're born, and instead of buying them some Jordans and buying all those stuff, you get them an IUL. Okay, you get them an IUL, something that will last forever and it's generational. I'm talking about you get an IUL when they're young. That'll help pay for their college, pay for their car, pay for their wedding, pay for their new house, and pay for their retirement. So, I mean, that's the gift that keeps on giving.
Right.
It's the gift that keeps on giving.
And if I can add to that, Greg, is that the younger you are, when you look at your insurance premium, the less of the cost of insurance. So, and not to get too technical, but just for an example, if you have $100 premium, let's say at the age 20, maybe only, this is just an example, maybe only $20 of that $100 premium, or let's just say $50 of that $100 premium would actually be paying for the insurance. And so that other 50 would be going towards the cash value.
Yeah.
Now, when you become older, let's say now you're 40 and you're still paying that $100 premium, now you probably got, just as an example, maybe 75 of that premium going towards the insurance, and only 25 will be going towards the cash value. So the younger you start, the better the advantage that you have more of your premium or more of your cash working for you, as opposed to when you get older. Because as you get older, the likelihood of you making a transition becomes greater, which means the cost of the insurance becomes greater. So you don't have much of that working for you. And another advantage I might add to a index IUL is that depending on the policy, you do have some flexibility in both your premium and the death benefit. So again, like some people, when they get their tax returns, they go out and party and buy Jordans, like Michelle said. But when you get a tax return, you can take, some of that, all of it, and put it into your IUL. And now you have that working for you in terms of if it's indexed into the market, and without making any adjustments. Because with the standard whole life insurance policy, you can't do that. So IUL gives you the flexibility of adjusting your premium as well as your death benefit. And that works both ways. So let's just say you fall as life happens on some hard times, and with a standard whole life cash value, people end up just letting the insurance go. Okay, but with the IUL, you can make some adjustments and not necessarily pay what would be considered the normal premium, and pay a little less and still keep that policy. And then when things get back and things get back to normal, so to speak, you can continue to make your standard premium. So the IUL gives you, there's so many different advantages to it. It's best to start at a younger age. It's also can be a good strategy that when you have some additional income, to put it in the IUL, because again, keep in mind that is tax-free money.
And so explain that. So you can overfund your IUL. You can
Correct.
continue to put money into your IUL. Is there ever a point where it's illegal? I don't know if illegal is the right word, or
it's taxable.
It's taxable, or that you put too much money in your IUL?
It is. And so they have a term, it's called a MEC. So the whole advantage of life insurance is that the powers that be said that life insurance isn't taxable because it's there to provide for the care of those who are living after the primary breadwinner leaves. But you have some people with their strategies, they can want to take advantage of that because it is non-taxable. So they want to put as much money into the policy as they can. But the government says, no, wait, at a certain point, if you put too much money into it, and usually, well, just for the sake of clarification, if you have a greater cash value than what the premium is, there's some other nuances, but a greater cash value than what the premium is, then they will say it's taxable. So in other words, if you got $100,000 life insurance policy and you end up, and let's say maybe 75, well, let's say you got 100,000 in cash value, then it's okay. That's going to be taxable because now it's no longer an insurance vehicle. You're using it as an investment vehicle. So they're going to tax it.
Mm-hmm. But I would add to that depends on your age and all those other kind of factors.
Right.
What makes it become a MEC? What it is for one person is not the same for another person.
True.
Okay, so your insurance professional can put together a plan and tell you what's the maximum that you can fund this account without it becoming what they call a MEC, which is a modified endowment contract. So that's what that means. So you can strategize and just find out which one works best for you. And then there's another thing with IULs, you can add what they call a premium deposit account. And you can add something to it. That's just another strategy that you can put money there, take money out to do investments and things like that, to do it. But you still be making interest on that money, even though you took some of the money out. So
and then you can also go in and increase your death benefit too, right?
yes, and that's what it allows you to do too. Yes. Mm-hmm.
And so by doing that, now you can fund even more money into to the policy to get more of the cash value.
Correct. Right.
And so I purchased an IUL for my daughter. She must have been 12 or 13 years old. So that must have been about 10 years ago I purchased one. And it's like building up really nicely. She has no idea what's going on.
Unless she's listening to this podcast.
Right. Let me see that policy.
but the beauty of I did it because you never know what your children are going to do, and
Mhm.
their ambition, and so I just wanted to make sure that she had that she's building wealth, and she's done a
Mhm.
good job. She bought a house last year.
Mhm.
And so the way I set it up, and I'll probably change it, but the way I set it up is I stopped paying on it, I think in another 5 years or so.
Mhm.
And so the policy will pay for itself. But then I think when she turns 40 years old, it starts, if she chooses she can start paying herself a retirement. She can
Mhm.
start taking money out for the
Mhm.
rest of her life.
Mhm.
But so we'll see. We'll see how that goes. But that's just the power, and that's how you build. You really build wealth with
Mhm.
insurance.
Yeah.
And the IUL is one of the ways. Um, can you purchase real estate? You guys mentioned that with the cash value, you can actually borrow the money and buy real estate investment. How does that work, and how is that paid back if it's paid back at all?
I want me to speak? Well, what
Yeah,
you
go
can
ahead.
do is, let's say you have you have maybe 50,000 or so dollars that you wanted to use towards a real estate investment. Well, you can get an IUL and have a separate account, put the 50 in, and then in 30 days, 31 days, you can take out probably maybe about 40,000. Okay. And you can go invest, do whatever you want to, but that account will still be making interest as if that 50 was still in that account. Okay. So, and not to mention, you still can act as though use it as collateral with a bank to use additional money. So that's why I love IULs, because there's a lot of flexibility, and it depends on each person's situation. But there's different ways that you can structure it. And going back into IULs, buying it young, another reason to buy a policy for a young person is because you never know what may happen with that young person as they grow up. As you and I know, if they get a lot of tickets, reckless driving, you know. I don't know about your kids, but my boys,
I was about to say
oh
that
my
sounds like
God,
experience, but okay. Sounds like
right?
some personal experience.
You know, as soon as they got that driver's license, it's like, whoa, I'm so glad I got this policy before then, because I've had clients I say, oh, I can't get one because he got reckless driving. You know, things like that can keep them from being able to get those policies. So it's real good to get it while they're sweet and innocent and young, you know, not getting in any trouble and
and
all of
health
that.
and healthy.
Yes,
Health plays a
and
huge
healthy,
role.
exactly. Because some of these young kids are less healthier than we are,
Yeah,
so
true that. True that.
mhm,
So
yes.
the younger, the healthier they are, the better to get the
Right.
insurance. And so here's the thing: to get a lot of these policies started, how much does it cost?
Oh my goodness.
And that's
That's the
that's the
beauty.
beautiful thing about that. As I stated earlier, IUL is flexible. So initially, when you're young and you're healthy, again, the cost of insurance is a lot less. So at that point, you want to get as much as you can afford, and so whatever the premium is that falls within your budget, get you a policy. And that's things, so if you're starting out early in your career, you're making, you're not making as much as you will when you say you get in the peak of your career. That initial IUL that you created early on, now you can add more to it. You can adjust the death benefit, you can adjust the premium, and the premium is still based on your original age. So as I alluded to earlier, not as much of the premium is going towards the cost of insurance. More of it is going towards the cash value. And as Michelle alluded to earlier as well, from an investment strategy. So even when you talk about a young person who's buying their home for the first time, they can utilize the IUL to kind of, in essence, attack two birds with one stone, creating a life insurance policy, and then having monies that they can use as a down payment on their home. So, like she alluded to, the same 50,000, you can open up an IUL with that, right? So now you have insurance on yourself. Take a portion of that out, I think up to 85% of that out to use as a down payment on your home. So you have a home as well as insurance. So again, so
You
with all the
get
different
technical.
strategies, well, that's a strategy. And again,
You
I'm gonna
giving
go ahead
all
and
the
strategy.
secrets away,
So
man.
that's a strategy that and again, so as I alluded to earlier, in our community, we more transactional oriented. as opposed to putting strategies together for the long term. So that one strategy that I just shared there is for a person who's in the market buying a home, and let's say they don't have insurance. There's a strategy right there. Give them the option to use two birds. You know, I don't want to say kill two birds, but address two birds. Nowadays you got to be careful, but address two birds with the same slingshot, if you
will. So Michelle, the terms "be in your own bank," infinite banking. What does that mean for you?
Well, infinite banking, the concept is basically using cash value life insurance policy and then lending money to yourself, and then using the cash value too as collateral. Okay.
And then paying yourself back.
And paying yourself back, exactly. And there's just several different strategies that you can use with the infinite banking. You know, and we have to. I let people remember that. Such as myself, if I get a policy on my grandchild, well, I'm the owner of that policy. So I control the cash in that policy. So I can be able to do certain things with that policy, cash, borrow against it, and everything else and that's another way of what you do infinite banking. You know, you use it, you want to have someone who's young enough so that most of the money is going towards cash opposed to insuring the person.
Yeah, absolutely. And so I control everything in the IUL that I purchased for my daughter. Right. And so I got it 10 years ago, as I said. And just because of what we're talking about now, what's ringing in my mind is I need to do my own policy review and maybe add more to it. Right. Because 10 years later, she's 10 years older. I think I maxed out on what I could overfund. But since she's 10 years old, I should be able to increase the death benefit.
Right. Increase the death benefit.
Yeah. And then maybe even double what I'm paying now. And then if I want to use that money, I can.
Right. And the key is making sure that you're with a professional that is setting up your account correctly. You want to have guaranteed insurability rider on that account, you know, so that, you know, when you want to increase it, you don't have to prove that you are insurable to do it. And you want to make sure that they add that rider to it. Definitely.
And so I have a few more questions for you guys, and I'll get you guys out of here. But those that are listening, if you guys want more information about all that we're talking about, how to build wealth with permanent insurance, index universal life policies, you can go to biglifefs.com or biglifefinancialservices.com and ask for a free quote on what we're talking about. If you want a policy review, just fill out the form and we'll definitely get back to you to take a look at your current policies. You may have a term policy. You may have a universal life or a whole life policy, maybe even an IUL that we can help you make more money with. So go to the site that's scrolling across, fill out the free quote, and we're happy to get back with you guys this week. We can get back with you this week. If those in the DMV, if you want to come into our office here in Greenbelt, Maryland, we do also have an office in Baltimore, or if you just want us to call you and discuss over the phone, we're happy to do so. A couple more questions. You build up a policy with a lot of cash value. Can you actually sell your policy?
Yeah, you can.
Yeah, you can. I don't recommend that option, but you can. Better than that would be an assignment of policy. So just as Michelle alluded to earlier, in terms of using that as collateral, you know. So when you sell it, you give up all rights. But I can assign it to someone. I can say, you know, I got X amount of dollars in my life insurance has an X amount face amount on it. I want to borrow X amount of dollars from you. Let me assign this to you to ensure that I pay you back. That way you have access to the policy. And there are companies out there that will buy your life insurance policy. But in essence, when you think about it, especially if it's a cash, some companies will even buy a term. But if it's a cash value policy, in essence, they're not giving you much more than the cash value that's already in your policy. So that's why I suggested I wouldn't do that. But in terms of another strategy, for those of us who are older and we do have grandchildren, as Michelle alluded to earlier, when you purchase a policy on your grandchild, you control that policy. And as I mentioned to you earlier, the younger the person is, the less the cost of insurance. So falling within the Met guidelines, you can overfund a policy on your grandchildren, take that cash to use it for investment purposes, and then it creates a win-win situation. You have a policy on your grandchild, the cash value is still growing, and you utilize that money to do something good with it. So there's so many different strategies. Assigning your insurance policy, you can do that. You can sell it. You can do it. You can borrow it against it. You can have it to even pay for itself, as you mentioned. Once you get to a certain point, you can say, okay, let the premiums cover the policy for the rest of the term, and now you don't have to worry about that additional expense. So
you can even borrow against the death benefit as well.
Exactly. Right. Exactly. Yeah.
Yeah. So not just borrowing with the cash value against the cash value, you can borrow against the death benefit.
Right.
Yes.
Yep.
How does annuities play a role in all this?
Annuities, I like to say annuities is just an insurance policy reverse, just to simplify that. In that when an insurance policy, you pay a premium, on the expiration of the person, the insurance company pays you the face amount of value. With annuities, and you have two types of annuities, but annuities, you pretty much, you fund it initially, whether you make one lump sum or where you make premium payments, and then at a designated time, and you can designate with annuity at what point, when I want you to start paying me out, it would start paying you out. Oftentimes that's tax-free, and oftentimes, depending on how it's positioned, it can really be lifetime income. So the simplified annuity is just an insurance policy in reverse, but from a financial strategy, when you understand that we're using what you call post-tax dollars, which means money has already been taxed, it's going into annuity. So when annuity comes out, it's not that money isn't being taxed, right? It becomes tax-free, or you can't really say tax-free, but it becomes minimum tax on the money that's coming out to you. If that makes sense.
Yeah.
And so overall, because we're running out of time, overall, what are some of the best ways, kind of just to recap everything, some of the best ways and benefits of building wealth through permanent insurance?
You want to go first, Dennis?
Let ladies go first. I'm a gentleman, so you can go first.
Well, I would definitely say anyone that is thinking about at any age, definitely get a permanent life insurance policy. If you're young enough to get an IUL, definitely get an IUL. If income or your income is, say, well, I don't really have a lot of money, get something. Get a term policy if you need to, or you can do a combination, as I do with some clients. We do a combination term, a combination of a permanent policy with a conversion benefit in it, where you can convert that term into a whole life, a permanent policy later, and also have a rider on there where they don't have to have a guaranteed insurability rider in there. So in case their health does change, we definitely can be able to get them more insurance. So the best thing is to get with someone. A lot of people think, oh, I don't have enough money, or I want to wait till I get something. We have some things called what you call annual renewable term, which makes it a very small premium. I mean, somebody could be my age, 50, 50 something, 50 something years old, okay, and get $200,000 and pay maybe no more than like $35, $40, but I have a conversion and a guaranteed insurability rider that you can add on to that to be able to, when you can, let's say, you get more insurance. So, my advice to anyone is to talk to an insurance professional that can be able to help you protect you and your family and get started.
And Greg, if I can add to that, just exactly what Michelle stated, the earlier the better, the sooner the better. So, there's no time that's better than now, right? Now is the best time to do anything. So yeah, you definitely want to get insurance. You want to, if you can, if it falls within your budget, you want to get a whole life. But as Michelle alluded to, a combination of a term and a whole life, or worst case scenario, just a term, because it's better to have something than not to have nothing, right? Of course, and sometimes a combination of both is the best policy. But the whole overall advantage is that you're accumulating wealth to kind of just better position yourself or your family at a later date. And, we can look at the stocks and bonds and all those are good vehicles as well. But the advantage of a life insurance policy, and especially for the average person, who's not wealthy, just a person who has, been in their career, have a 9 to 5, that is one of the best, safest vehicles because you don't deal with the fluctuation of the market, that a person can use to accumulate some wealth for themselves. And then, as we alluded to earlier, with the different options, you can utilize that to even grow your wealth even more so.
All right. I'd like to thank you guys for all that. I think the key is just to get started as early as possible.
Yes.
Even if it's just, if those who are out there, if you can afford, say, $50 a month, now you get started. And then maybe a couple of years from now, we can increase that. But that's how you really start the process of building wealth. And then with the UL, Universal Life, or Index Universal Life,
right?
The interest is compounding. And so it's probably one of the fastest ways to become a millionaire is just growing the cash value inside of a life insurance policy, because it's all growing tax-free. And then now you can borrow the money once you've grown it, and invest it into other investments that's going to give you passive income. And then you pay yourself back. You become your own bank. And the younger, the better. One of the people, Daisy Daly, and I think I know who that is just making a really good point. They're saying that we should do this whole thing on Instagram where there's a younger crowd, they're millennials, but they need to know how to build wealth. I mean,
yes.
We're an older crowd, but millennials need to know, and they need to get started now. And so there's lots of millennials that want to become millionaires that just don't know. And insurance strategies, obviously, I like to talk about real estate strategies, but these insurance strategies are the best way for them. And so I'm going to have to ask you guys to come back maybe next week or the week after. We'll go Instagram Live. That's probably going to be a challenge for Dennis. He probably doesn't even know what Instagram is.
Ouch. I owe you,
and Michelle's laughing, but she just got an Instagram account.
Well, okay, you're right. You're right. I don't know how to post things. I've been playing around a little bit.
We just taught a class. Were you there yesterday?
I missed it, and that's what I was just texting. I said, is it recorded? Can I get a recording? Yes, I'm definitely going to study it.
There you
go. Yes.
All right. So she's saying, let's see. Yes, this is definitely valuable. Agreed. Can you stream? Yeah. So we're unable to stream both on Facebook, YouTube, or all three: Facebook, YouTube, and Instagram. There's no platform for that. This does go to all of my podcast channels, but we'll definitely go on to Instagram next week if you guys are available.
Oh, yeah, definitely.
Because I do think it's important for us to spread the gospel. For our community, and I think we all agree that the younger, the better.
Yes, there's a saying. They say, I didn't mean to cut y'all, that those who understand compound interest, earn it, and those who don't pay it.
That is a very true statement. That's a very true statement.
I want to close with this. We have to understand the power of insurance and the power of the cash value. And Michelle, you guys hear me say this all the time. In the Jewish community, they understand it. And when one passes away, 2 millionaires are created. In the African American community, when one passes away, unfortunately, we're creating GoFundMe pages.
Yeah.
And it's only because we just don't understand the power of insurance.
Yes.
benefits of it, and how our money can grow in a cash value policy, and it's compounded, and it's compounded, monthly. And
Yeah.
so and it gives you that death benefit. So, many people tell me, even before I really got into financial services, that, insurance is the best way to build wealth. And I never understood it because, I've been in real estate for over 30 years, but I clearly understand it now. And because of that, I'm really helping my daughter understand, and she's got policies. And because of us talking now, I'm going to increase, her premium so she can grow even more. So it's just powerful. So I just like to thank you guys. We need to do this more often,
Yes.
to educate the community.
Yes. I
Because
definitely agree with you 100%.
as a people, we're underinsured. And I think it's primarily because, we're not getting out in the community educated. I think it's either 4 or 6% of all insurance agents are of color, of our color.
Yes.
And then the other colors, they're just not going into our community. So it's our social responsibility to do so. And so we're going to do it here at Big Life Financial Services. We're definitely going to do it. We're going to get out in the community. We're going to educate, and then we're going to help you guys build wealth.
Right.
And so if you guys want to talk to Dennis or Michelle or even myself, go to biglifefinancialservices.com or biglifefs.com. There's a form you can fill out if asking for a quote, fill that out. Or if you have a policy and would like for us to review it, we can either do it over the phone or do it in person. We can
that's wonderful. Yeah.
we can do a Zoom call. Fill that form out, and we'll get back with you as soon as you fill it out. All right, Dennis. Michelle,
Okay. Yeah. I was going to say, even if they're out of state, we have agents here that are licensed all over.
Absolutely.
So, so depending, doesn't matter if it's wherever you are, if someone can help you in that state.
Right.
All right. Thank you guys so much for taking time
Thank
out.
you. I really appreciate the opportunity to share some information with you guys.
Thank you.
Thank you.
Take
Guys.
All right.
care.
Thanks so much. Have a good one.
All right.
All right. Bye.